What's up YouTube? My name is Andres Restrepo and welcome back to my YouTube channel. In today's video, we are going to be answering the top 10 questions that most first-time home buyers have when going through the lending process. For today's video, we are bringing on Mike. Mike, tell us a little bit about yourself. Who are you?
Thanks. I'm Mike Koran. I've been a residential mortgage lender now going on 20 years. I run a division here in San Francisco, and we have offices in the East Bay and Marin. And I'll take it away from there.
Yeah, and this one in Potrero Hill, which as you guys can tell, it's a pretty sweet office. Mike is right next door to Mason on Mariposa, which is a building that I used to do a lot of leasing in. So if any Mason residents are watching this, definitely reach out to Mike because he's local and he'll be able to get you guys all squared away with the pre-approval process. Now, as a lot of you know, getting pre-approved is a very standard process in home buying, and it's usually one of the first things that happens. So let's just jump right into those 10 questions that I know a lot of you are waiting to hear. All right, Mike, so a lot of buyers generally like to ask, how long does the pre-approval process usually take?
It's a great question. So after an initial call or a meeting or Zoom meeting, we collect all the documentation that we need to actually get the loan fully approved through underwriting. And it usually takes an average home buyer 24 to 48 hours to gather up the documentation needed and to complete the online application. Once it goes to our underwriting team, it's usually about 5, maybe 7 days, depending on the loan product and type, before we have a fully underwritten pre-approval. But we can always change the prioritization of the underwriting line. If you need to get your loan approved faster, if you have an upcoming offer, or if there's a property that you absolutely want to go see and you need a pre-approval, just let us know. And we have full control over the underwriting line and can make that happen for you.
As of late, these adjustable rate mortgages have been making a big, kind of comeback. They're getting in the scene. A lot of people are starting to consider them again. Why is that? Why do you think so many people are kind of gravitating towards adjustable rate mortgages?
Yeah. This year in 2022, we've seen the quickest, swiftest, and largest increase in interest rates in the last 20 years. So at this time last year, it's October 2022, so October 2021, we were pre-approving clients in the 2% range. And now clients are getting pre-approved in 5, 6, 7, and depending on the type of loan, sometimes even higher than that. And so as a result, everybody's looking for a more affordable way to buy a home. Fixed rates have always been kind of the conservative norm and what people gravitate towards on loan products, but ARMs give the flexibility of a lower rate for a finite period of time. So an adjustable rate mortgage is going to provide a fixed rate, but that fixed rate's either going to be for 5 years, 7 years, or 10 years, as opposed to the traditional 30-year fixed loan.
Now, is there any risk to those? Because a lot of people, always like to reference 2008. Like, wasn't there a bunch of adjustable rate mortgages back then? How would you respond to that?
Absolutely. There's always risk in anything that can change.
Okay.
And so an adjustable rate mortgage does have risk, but the thing to remember is that if you're going to take an adjustable rate mortgage, let's say that's fixed for 7 years, that means you have 84 payments where that payment will not change. It will be fixed for that 7-year period. And so the reason that people are gravitating towards this product is because from the vantage point of the economics that are happening right now in the current market, rates are at this all-time high, but it is a short-lived period of time. We believe that rates will normalize and get back to a much more affordable level somewhere between 12 to 24 months from now. So in the next, let's say 2 years, or even 3 years if it took that long, you could do a refinance, get away from the adjustable rate mortgage, and get onto something that's fixed long term.
Right. Now, is there a cap? Let's say somebody gets a 7-year adjustable rate mortgage and they hold on to that mortgage for that period of time because, lo and behold, rates kept going up, right? And there was no opportunity to refinance. So what happens then? Is this borrower going to be subject to an unlimited increase, or do these ARMs sometimes have a cap?
Yeah, those terms are completely written into the note that you get, the promissory note on the loan.
Okay.
And the typical cap is that it can't exceed 2% above the initial note rate in the first year of adjustment.
Okay.
Okay. Then the maximum that it can go up is 5% above the initial rate.
How often does the typical homeowner, how often do they refinance their mortgage?
That's a great question. So this is definitely something that comes up a lot. when can I refi and how often can I refi? So currently, at least in the state of California, loans turn over every 2 to 3 years. That turnover, let's say around 3 years, provides a perfect example of another reason why taking a look at different products other than just a fixed rate is a good idea. And the other thing to consider is that, with an adjustable rate, if you end up going that direction, you can always refinance. There's no restriction that you have to keep it during that fixed period of time.
So that's the good thing about working with a professional like Mike, that they'll nurture that relationship that you've established. It's not like you won't hear from them after the deal closes. They'll keep you in the know, and they'll let you know what's happening with mortgage rates, and they'll reach out when it could make sense for you to refinance. And that's another one of the beautiful things of owning real estate, that you're able to lock in a payment, and you're actually able to over time refinance that payment and make it an even lower payment, something that you can never do with a rental, right? Because typically those only go up. Our next question is, in many rate sheets, there are 2 rates visible. Why is the APR higher, and which rate does the consumer pay?
Oh, great question. So to begin with, the consumer pays the note rate, okay? And the note rate is the rate that is locked in. The note rate is the rate that dictates and determines the actual payment that's going to be paid on a monthly basis.
So is that the lower rate of the 2?
That is the lower rate of the 2.
Got it.
The APR is the annual percentage rate. And just like on a credit card or a car loan, what the APR is it is a representation of what the annual percentage rate is over the total time of the loan, based on the cost involved in the loan as well.
Right, so your closing cost.
That's right. So it comes down to the closing cost. That really is what is determining the final APR of a mortgage loan. And so it's a very interesting topic, because oftentimes consumers and buyers are out there looking for like the absolute lowest rate. And I get that, because the lowest rate also is going to give you the lowest payment.
Correct.
But it doesn't mean that it's going to give you the lowest cost. In fact, the lowest rate is going to have the highest cost. And so the way that it's really helpful to think about with an APR is, during the refinance boom of 2020 and 2021, there were times where if you went up by 0.1% in rate, you could have all the costs of a loan covered for you. Now at that point in time, if there's 0 cost on a loan, the APR and the note rate will be identical.
Okay.
Because there's 0 cost, the APR doesn't fluctuate higher, and it stays identical to the note rate.
Got it. All right, Mike. So with rates being higher now, will I be eligible for a refinance when they normalize? And if so, when might that be?
Yeah, that's the question everybody's asking, and something I talk about, feels like dozens of times a day. So the way the loan structure works is that when you close that loan, your first payment is generally the very following month, or depending on when it closes, it could be the month after that. Once you've made 6 consecutive monthly payments, you're eligible for a refinance. And so that typically is about 6 to 7 months after you close on a purchase.
Got it.
Or an existing refinance. At that time, of course, if rates are higher, there's no real reason to consider a refinance.
Of course.
But our expectation is sometime in the next 12 to 24 months, we're going to see rates drop, we're going to see them normalize. And at that time, we're going to be reaching out to every single person that we've closed a loan for and evaluating, does it make sense for you now to lower your rate and payment?
Question number 5, what is a rate lock?
Okay, so a rate lock is what we do to solidify a specific rate for a finite period of time.
Okay.
So assume that you were a buyer and you just got into escrow on a contract. We're eligible to lock your rate. That means we're going to take a look at the spectrum of investors that we work with, all the program options that are available on day number 1, and we're going to determine, does it make sense to lock that rate for the, let's say, 30-day escrow.
Got it.
Rates can be locked for longer periods of time. In general, after 30 days, it's about every 15 days, so 45, 60, up to around 180 days.
Okay, and there's a cost associated for doing that, correct?
There's a cost associated for the time period in which you lock. Typically, there are lenders that have lock-in fees. We don't charge an upfront lock-in fee. We lock all of our clients' loans, usually somewhere around the first couple days of getting into escrow. The really nice thing about locking, especially in a market where rates are rising, is that we're hedging against tomorrow or the next day or next week being higher.
Right.
And so we want to solidify a rate as soon as possible. And then the advantage of working with a company like ours is in the event that rates drop and we actually have a reversal of the current trend during that escrow period, we can renegotiate the terms, we can relock the loan if the market allows for that. And so we're always looking to make sure that that rate is locked in and that there's no concern that we missed an opportunity or that their payment might go up because we didn't lock in early enough or something like that.
Now, Mike, let's say I am not in contract to buy a home, but I am seeing rates kind of continually going up, and I have a feeling that in the next 30 to 60 days, I'll find what I'm looking for because I'm working with a sick agent like Andres and Martha, who is always kind of hustling behind the scenes, you know, showing us off-market properties, and we're like, hey, we want to get ahead of these rates. We're shopping within our timeline, you know, can I do a 60-day rate lock, let's say, you know, like today, and how much would that cost me? Is that an option?
Yeah, so we do have it's called a lock and shop product.
Okay.
Where you can lock in a loan ahead of actually finding a property. So you're still looking and shopping for the property.
Right.
The drawback with that is that in general, it's a more costly lock.
Okay.
And so for the clients that do that, there have been some amazing opportunities this year where if you locked in June and closed in August, you were definitely saving on the rate because rates had risen then as well. However, if you do go down that path, one of the things that we'll always do is take a look at what does the market look like when you actually get into contract, and if it's better or there's an opportunity that's better than what we locked in previously, again, we're going to look at renegotiating the terms or relocking with one of our other investors.
Question number 6, what is debt to income ratio? It always comes up when people are getting pre-approved, when they're getting loans. What is it?
Yeah, so debt to income is basically what it sounds like, although there is a mathematical equation behind it. And so we have to evaluate what your total debt is now, currently, as well as what the debt of the new housing expense will be.
Okay.
And then put that in a ratio against your gross income. So that's your pre-tax income.
Got it. So we're looking at like credit card debt, you know, maybe medical debt, any other sort of debt like a car note, these types of things.
Yeah,
right?
Any installment debt, so car loans, student loans are a huge one that we're seeing on credit reports these days. Essentially, it's anything that shows up on your credit report, any other property that you might own, and anything that could be considered a liability has to be taken into account.
What is the standard debt to income ratio that lenders are looking for?
Really important point. So there's different categories for different loan programs. So kind of starting from the most conservative is you're looking at jumbo lending.
Okay.
So currently a jumbo loan is essentially anything over $970,000 in the high cost areas like San Francisco and the Bay Area as a whole. And so if you're in a loan product that's higher than that, you're going to be in the most conservative debt to income ratio, which currently is a maximum of 43%.
Okay.
We do work with investors that allow for up to 50% on those products, but when you are getting something that's not normal, you're typically paying slightly higher interest rate for that opportunity. On conventional financing, we see 50% all day long. That essentially means that half of your pre-tax income can be used to cover your overall debt, including the new housing expense. So the mortgage, the property taxes, the home insurance, and if it's a condo, the HOA fee. And then there's government programs. So FHA is a big government program that most people have heard of. They allow for even higher debt to income. So for the right circumstances, sometimes we're seeing that push 55% or even slightly above. And then lastly, VA loans for veterans. VA will take any debt to income that they feel fits into their box. So we've had approvals in the 60s, never really seen anything above 60, but high 60s has been something that is eligible for approval.
So question number 7, and we get this one so often, and I think it's a very funny question, and I'll tell you why in a moment, but it's, will my credit score be affected if I get multiple approvals? And if so, by how much? Now, before I let Mike go ahead and answer that question, here's why I think it's a funny question. Because what's the point of credit? To get a loan, to get to be able to buy real estate. This is good debt.
This is one of those vague topics that comes up a lot in our industry, and the credit bureaus are not concrete about how this works for each individual because their scoring model is just so all over the place. The typical rule of thumb is that if you have good credit, which we consider really anything 700 and above, that running your credit for any reason shouldn't have a detrimental effect on the score. And for those that have excellent credit, you rarely, if ever, see any kind of change in credit scores due to a mortgage lender running credit. Now, where credit scores can drop is for somebody who has damaged credit to begin with, or somebody who has lower credit scores and they've been out there looking to obtain credit in multiple areas all in a finite period of time. And that's usually not mortgage loan reporting.
Right.
It's they're out there trying to get car loans. They're out there trying to get new consumer debt like credit cards.
Right.
They're trying to maybe buy a recreational vehicle. And so they've ran their credit, and you'll see the number of inquiries,
Right.
20 or 30 in the most recent 30 or 60 days. Sometimes you'll see them losing points, and especially if they're on the lower end of the credit spectrum, that's where you'll have like the most risk.
This one comes up quite a bit. Question number 8. Are any of the lender fees negotiable, right? Because different lenders have different programs and different fee structure.
Yeah, another great question. So I feel like everything is negotiable in the sense that although we have fixed costs for running our business, which include processing loans, underwriting loans, and funding loans, there's always room to make things work for any buyer or any homeowner. And so an example would be if somebody does not have enough money for closing costs. They have enough money for their down payment, but not enough for closing costs. We'll look at ways to provide a lender credit to restructure the loan so that we can get them into the home with as little down as possible.
Okay.
There's also, of course, as you know on your end, asking for seller credits. And as we move into more of a buyer's market, that's definitely going to be something that is utilized a lot more. Sellers are going to be apt to get their home sold, and so they'll be more interested in helping to provide some assistance. But when it comes down to negotiating, what we're looking to do is find kind of the perfect balance for every client, and that is going to be different for each individual person.
So we kind of touched on this one, but I think it's still worth asking. Do I need a particular credit score to get favorable rates?
The higher the score, the better. And so definitely when you're looking at the spectrum of credit scores, in general, every 20 points has a slightly better rate associated with it. So starting at like let's say a 640 credit score, if you're comparing that to somebody who has a 660, the 660 is going to get slightly better rate. 660 is going to get slightly worse rate than 680.
Right.
And 680, slightly worse than 700. That being said, when you get into 780 and above, it's rare that a bank or lender or investor will offer that much better.
And then question number 10. So Martha and I work with a lot of first-time home buyers, and we get this one quite often. And the question is, if I don't have enough money for a down payment, can I use a gift from my family?
Absolutely. In this current environment where affordability has been more difficult for should-be buyers and homeowners, we're seeing gifts from family, and a family member can be anything from grandparents, parents, sister, brother, all the way down aunt, uncle, cousins, and everyone's pulling together to make this work so that a buyer can actually realize the dream of home ownership.
To close out the video, and this is a bonus question for you guys out there, which maybe you're not quite ready to reach out to a lender yet, but you're just kind of curious to know how much can you afford. So Mike, is there a way that, for somebody to roughly calculate how much they can afford, kind of like some back of the napkin math, if you will?
Yeah, back of the napkin math. So without knowing somebody's debt, because that really is such a key factor.
Okay.
If somebody was to come in and say, hey, Mike, I have zero debt and I make $100,000 a year, I usually will say, if you take that $100,000 a year and multiply it by 5, that's about somewhere generally speaking, the type of loan size that you should be able to afford.
Absolutely. And again, one of the many reasons why it's so important to rely on professionals like Mike. Does not cost you anything to reach out to Mike, ask him questions, get the ball rolling on a pre-approval process. It'll let you know where you stand today and how you can prepare if you're thinking about buying down the line. Now, it's also worth noting that when you hire a good buyer's agent like Martha and myself, we're a couple, we work together, we also do not cost you anything, and we advise you on each step of the process to make sure that you're making the best decision for you. If you found value from this content, make sure to give the video a like, comment, and subscribe. Let us know what you thought about the video. Mike's contact information is going to be below. Mike, thank you so much for your time today.
Thank you.
Doing the video with us, and make sure to reach out to this guy if you want to get pre-approved. We'll see you guys in the next one.